Vaibhav. In today's session of Visual JForex, we'll be starting afresh with a new indicator, Ehler feature transform, which is shortened as EF transform, and we will see how we can design and develop the algorithm using this indicator. So let us now head to the Visual JForex board, which has been developed by the Dukascopy Bank SA. You will find this is indicator listed amongst the oscillators. This is just below the DMI. In last session, we were using the DMI. Now it's the turn of the EF transform. So when we define these four input values, we get these two output values, which can guide us in the direction of the trend. We can utilize these output values to see whether the undertone is bullish or bearish, and then accordingly place the trade. We have to, of course, define this instrument, and mostly we keep the Euro USD as our default instrument, but if you want to change, you can always change that. Then comes the candle period, and this is quite important. And this determine on which time horizon you will be trading. So if you want, you can work with this 10 minutes or 5 minutes, or you can make it larger and go for the time frames like 1 hour or 4 hours. Means all the options are there. And for today's session, I'm going to design the algorithm using the hourly time frame. So I will change it to hourly, and this look back period will be changed to 1. So we will have the last hour's EF transform data, and the number of candles which will be utilized to calculate these output values is defined here, and we will keep it as per the default setup 10. So no change there, and we get this Fisher 11 and signal line 11 as our output. Now I will give you the brief idea of the logic which we are going to use while looking to trade in the Euro USD. So I will change this chart, and this will also be changed to hourly. Okay. The logic is fairly simple. We want to be trading with the trend. So whenever we have these EF transform values above 0, then only we will be looking to initiate the buy trade. And for that, our preferred setup is going to be of the crossover. Whenever we see future line crossing above the signal line, we will look to initiate the buy trade, and to make sure that we are not really getting involved in the trade when the underlying instrument has run its course and now it might be changing the direction. To make sure that's not the case, we are going to compare its value with the output value 10 hours back, and only if it is still above and now crossing over again, then only we will go to initiate the buy trade. So we are going to define this condition, and first thing is that its output value should be above 0. The Fisher line as well as signal line should preferably above 0, and in the penultimate hour the Fisher line should have been below the signal line, and in last hour the Fisher line has crossed above the signal line, and the output value 10 hours back, both the Fisher line as well as signal line should have been below the last hour's output values, and only in that kind of scenario we will be initiating the buy trade, and the conditions will be reversed for the sell trade. We will need the sell side crossover, so Fisher line should cross below the signal line for the sell trade to be initiated. Both these output values should be below 0. Only in that kind of scenario the sell trade will happen, and as I pointed out, in case of the buy trade, here also we are looking at the fact that this should be the continuation of the trend, and we should not be getting involved when there is a high chance that underlying instrument has run its course and a reversal of sort might take place. So we will be comparing the last hour's output value, Fisher line and signal line, with the values 10 hours back, and this time around the value should be lower, and only then we will be initiating the sell trade. So that's how the logic is for this station of the algorithm development using the EF transform. So now we head back to the Visual JForex board. Here, first thing first, instrument subscription needs to be carried out, and for that, the logical blocks will come handy, and these three will be needed. This time around, we will be using ontick as our start point. Okay, and after that, default variables, default instrument, Euro USD. We are not going to change anything this time around. On tick, last tick, instrument should match the default instrument, and tick instrument should match the instrument of choice, which is Euro USD. Okay, so first input equals second input, and here also first input equals second input. After that, we also consider the position amount. All position amount should be 0. And to define our crossover requirement, we will need two EF transform blocks with the loopback period of 1 and 2 respectively. And apart from these two for crossover, we are also going to need the third one to compare values over the time horizon of 10 hours. So we need additionally two blocks now. One is already in place. All the three will be of hourly time period. I will change this. It will be 2, and this one 10. Okay, and other two input values will remain as it is. And then we will use these output values to define the crossover, and also the requirement that this should be in continuation of the trend, and this will help us define higher high or higher, lower low kind of situation. And along with this, we will also need to look at the price volatility while defining the exact entry point, and also making sure that there is enough of volatility in the underlying instrument. So for that, we will use the historical candle info. Will be hourly. We will take a certain percentage of the last hour's closing and opening difference. and we will use that to define the entry point. For a buy trade, we will deduct it from the last tick price. For the sell trade, we will add it and then we will place the limit order. And also to look at the price volatility over last 4 hours, we are going to need one more get historical candles block. This is simply get historical candle. So this is single, and I will change this to 1, which means it has already closed. Here we will be considering opening and closing difference for this candle 17, and in case of this get historical candles, we will change the candle amount to 4 and then take its high and low value, and make sure it is above certain values. We will define it, so that will help us in defining the volatility, which is going to be a prerequisite to avoid the trades being placed in sideways kind of market conditions. It is going to be 1. This will change to overlay. Okay. And to retrieve the individual data points from this array of data, we are going to need the loop viewer. Here it is. I will name it HLD. And 2 more get historical candle block for pinpointing the exact entry point. This I will change to 10 seconds. It will be 1 and 2 respectively. And after this, we will take the calculation expression block and look at the actual difference between this get historical candles, candle 18 high low and candle 17 closing and opening difference. So for that, we are going to need 2 more calculation expression blocks. We take HLD candle high and deduct HLD candle low. This is going to be A1 minus A2. And I will name it HLD. Now coming to the last hourly candle, candle 17, we will also consider its opening and closing difference. Actually, we will have to calculate it both ways. Candle open being deducted from the candle close, when we will have to look for the buy trade, and when we will be looking at the sell trade, we will need to deduct its closing value from the opening value, as the requirement is going to be different for the buy and for the sell trade. So I think this calculation will need this one block and one more. So okay, first we deduct the opening value from the closing value. A1 minus A2, and one more. I think I should add two more because we also need to define the 20 pips criterion. So for that, we will take the pip size and simply multiply it by 20, which then can be compared with this actual high-low difference later on whenever we will be defining the conditions. Okay, so here now this time around we are deducting the candle 17 candle close from candle 17 candle open, and this is going to be for the sell side. And then comes the minimum requirement of 20 pips. For that, we are going to need default instrument pip size, create a new variable which is going to be named mpd, and result is going to be a1 into a2. Okay, so this calculation is also done. So with this we have defined these four values which we will use to define the conditions which will be related to the price volatility. And with this we will stop here for the day, and in next session I will go on to complete the sell side of the equation. I will explain to you how you can define the conditions which need to be put in place for the execution of the buy trade, and then in subsequent session we will turn our focus to the sell side. So thank you all for joining in. Do subscribe to the Dukascopy webinar channel to stay updated on market development. See you next time. Till then, goodbye.